Walk me through what happened yesterday. What was the sell-off in equities really about?
Well, in a sense, it seemed to be a classic kind of, defensive outperforming. Everything cyclical is getting hit. Like if you look at a ratio of, say, like XLI to SPX, you see a big move down in there yesterday. So even as stocks dump, it's the cyclicals especially getting hit. And it's this move for, like, call it the second derivative inflection sell-off. As soon as we hear high watermark for growth, we immediately go from peak growth to no growth is apparently how the equity market might have interpreted it. So if you see, potentially a bad time ahead for high growth stocks and for cyclical stocks like industrials and techs. And then the 10-year doesn't really break meaningfully above 3, starts retreating, the banks go down too. Well, there's really not much left to go up.
So, Jim, what do you do? I mean, do you want to be more in cash? Do you want to buy the dip in those cyclicals, or you toe the line?
I think you're still buying the dip because I don't think we're getting close to recession. I think we're going to see 2 or 3% growth looking forward for the next year or two. So I think you're still buying the dips, but do so a little bit more tentatively than we were last year, because the higher rate environment makes it more difficult for stocks to make progress. The higher rate environment, because it makes distant earnings out in the future less valuable, plays against growth stocks. And I think that's one of the main reasons why all the technology stocks were hit yesterday. Those distant earnings are less valuable in a high rate environment.
Well, is it the high rates with respect to technology, Jim, or is it actually some idiosyncratic but really powerful points about each one of those tech stocks? I mean, you've got Amazon coming out and saying we're going to keep investing an awful lot of money. You've got data questions about Facebook. We haven't seen those earnings yet, but real questions about that. You've got Apple saying maybe we're not going to need as many iPhones. It seems like there's really a problem with each of those tech stocks, quite apart from how much the interest is being charged.
I think the main problem, David, is really with Facebook. The hearings last week with Mr. Zuckerberg at Congress, those had the feeling of, Congress is circling at some point to do some pretty heavy regulating of social media, or perhaps even 2 or 3 years out, a breakup of Facebook. It's got that sort of AT&T in the 1984 cycle feel about it. So there is that idiosyncratic risk, but I don't think it's totally across the board. I don't think you should have been too surprised at the commentary on Apple yesterday. Apple is a whole ecosystem rather than just one device. So I think that some of that news has been kind of overplayed. I do think one of the reasons the market was so volatile yesterday was pro-cyclical strategies in the equity market. There's a lot of investors who are basically forced sellers on the dip, and I think that's creating an inefficiency that's exacerbating the volatility.
So that's sort of a technical inside the market, but there's also the fundamental, and that leads me to earnings estimates, Luke. If you come inside the Bloomberg, so the white line is S&P earnings forward estimates for this year. The blue line is for next year, and the yellow is for 2020. We're seeing next year roll over just a touch, but we're still holding up okay for this year. Is this divergence that we're starting to see what the market is starting to get really worried about?
I think when I talk about like the second derivative and folks worried about that, that's the perfect chart to show it. That's kind of
perfect chart. Luke.
Yeah,
okay,
no,
I'm in.
that's exactly why. And like
you're perfect, practically perfect
just
in every way.
Somebody warned Boeing not to say high watermark on the call, but there looks to be something. And Bespoke Investment Group just pointed this out, put out a great note. One other like hallmark of this earnings season has been this really ridiculous head fake we've been getting when stocks report earnings, they go up 0.5%, immediate jump on average, but then by the time all's said and done, the move from top to bottom is nearly a full percent, and this is happening nearly on a consistent basis. We see the Google's probably the best example. We were kind of seeing a mini example of that in Twitter this morning, but in terms of looking at the fundamentals and showing that those fundamentals still remain solid, Capital One reported earlier this morning. Morgan Stanley came out with a note, said credit trends look strong, improved both for the consumer and in autos. I'll be looking to Visa later today to try and see is the U.S. consumer holding up? How much of a hangover did we get from the holiday season?
But Jim, to come back to earnings for a second, is it the level of earnings or is it the slope of the curve? Because we've had a nice ramp up in part because of tax cuts. Let's be honest. That's part of what's doing it here. We're not expecting to get another round of tax cuts next year. And is the market basically being smart and saying, okay, what have you done for me lately?
Yeah, I think there's an element of that, David, but I do think that even in slower growth, I think you can overplay the second derivative point. I think even in slower growth, if earnings are still making progress over the next 2 years or so, I think you will still see a pretty solid undertone to the equity market, albeit not the best of the cycle, but it may be slowing down, it may be getting into the late innings of the recovery. But I do think that unless we see an acceleration of the next recession, unless we see that brought forward, I think we're still in a buy the dips kind of market in U.S. equities.
But Jim, what sectors have not yet priced in the earnings optimism?
Well, I think they mostly have, and you know, in a
sense,
so
why would you buy the dip?
If they've already,
Jim, if they've already priced in that earnings momentum, why would you buy the dip?
Well, they've priced in the first quarter earnings momentum. I think that you buy the dip unless you see a recession coming in the next 18 to 24 months. And that's what I don't see right now, don't see yet. I think there's maybe a 20 or 30% probability of that, which is why I'm a little more tentative buying the dips than I was 6 or 12 months ago. But, you know, having said that, the answer to that uncertainty is some diversification in the portfolio. Have a bit of international, have a bit of real estate, have some high-quality bonds. You know, a diversified portfolio is kind of essential when you're getting towards the end of a recovery like this.